Our own, love saying that, our own Keller Williams, Paul Hakim. Paul is now with us. Many of you know he had his own independent commercial brokerage and consulting company. And although he's still certainly consulting a lot of people and doing just a ton of deals on his own, he is with our commercial division now, giving a lot of knowledge and experience there. And I was happy after our call last month where we talked about doing self-directed IRAs and being able to invest that retirement money in real estate. There seemed to be a lot of interest, and I know Paul and I have spoken before, and he has a lot of knowledge and information in this area. So I thought it would be great if he would come on this month and talk to us. And I hope, starting out the new year, that everyone has checked their net worth. We talked about that last month. And in addition to checking your net worth, that you've made a goal of how to increase your net worth this year. And if you haven't done that, you can, and you sort of are lost or don't know where to go with it, by all means, shoot me a text or something, and, we'll have a little call about it. I'm happy to give any advice that I can to any of you on that and on building your net worth plan for the future. So I see that Paul has shut his camera off for a minute. Does any, oh, here you are.
Sorry.
So welcome, Paul.
Hey, thank you for having me. I think I recognize most of the people on the call, at least from a name perspective. But, again, I'm Paul Hakim, part of the KW team now at this point. I've been a licensed broker for 38 years. It's amazing how time flies when you're having fun. But I was in Ulster County multiple listing and on the board when we decided to make the transition from books to technology, right? So it's been that long. But as Rosemarie stated, I operate mostly as a principal, and I consult with investments that I make into those entities, as well as with other brokers, helping them get their deals across the finish line, and all things related to capital stack and forming the entity, the investment vehicles for the investments moving forward. It's great. Everybody's focused on, building and creating the equity. But, what I like to, also focus on is, it's not what you make, it's what you keep. Kind of strategy, and also, for a lot of you active brokers, you're earning active income, and transitioning to more of a passive income type strategy here as you migrate and mature through the real estate investment cycle, right? So right now you're out there and, you're killing to eat, right? You've got to bang another sale, another listing, through the transaction, and then that is gone. Hopefully there's going to be some residual income coming from referrals, but again, you want to get into that passive recurring income type revenue stream as opposed to that active revenue stream over time. Now, I know you guys discussed and talked about the self-directed IRAs last year. Rosemarie and I had a long conversation over dinner about it. And 100% of my IRA is invested in real estate. I did that over a multi-year period. I bounced around between a bunch of different custodians who enabled me to do that. And I'm not really going to, this isn't a commercial. I'm available to help people, as needed. If you have questions, by all means, feel free to reach out to me. Happy to answer any questions and give you direction. But that said, I'll give you a little bit of fine print here, as we start. I'm not giving you tax advice, right? I'm going tell you about some strategies that we have employed on our individual investments and strategies that I have seen deployed throughout the industry and with a lot of other, smart investors, and, I'll kick that up to a higher level, way above all of our stratospheres. Sam Bankman-Fried has been in the newspaper, in the news here a lot with FTX recently, hasn't he? Right? You've heard about the involvement of his father in the company and the structuring and the underlying investment fund. I don't know how much you read into that, but I know somebody who actually took Sam Bankman Sr.'s class at Stanford, and he teaches a class on strategy and equity building. All right, so it's, again, all around not what you make, but what you keep. All right, so he's teaching a class on equity building strategies, and it's pretty interesting to see, how his son went from, playing the video games and doing the programming stuff that he was doing into a sophisticated company. You see what that background is and what he heard around the dinner table for years. Another interesting tidbit, somebody else that took his class was Peter Thiel. You guys have heard of him, right? He founded PayPal. Interesting note, Peter Thiel, when he founded PayPal, funded it with his IRA, and his shares of PayPal are held in his IRA. All right, so any growth or any sales of stock or any capital transactions, that he has made, he was an executive at the company. He's got other executive positions. He's probably not living off of that money, right? But he's growing that money in a tax-deferred manner, right? So say he's got $1 billion worth of PayPal stock in his IRA, right? And he sells 100 million of it because he wants to go make another investment in another company that he sees merit in. It's not a taxable transaction, right? So to get $100 million, if it was you or I, selling $100 million worth of stock that you had no basis on, right? Because you were a founder, the majority of that would get eaten up in tax, probably close to 50% of it. So he would have to actually sell, close to $150 million or $170 million worth of stock, depending on what his tax situation is, to be able to have $100 million worth of liquidity, or to go make that investment moving forward. But in his IRA, there's no tax, so he only had to sell $100 million worth in that scenario to make that subsequent investment, right? So that's good tax planning and tax strategy. We deploy that in all different types of scenarios. I personally have been around. I used UDirect IRA for years. It was a little bit cumbersome. They are an IRA custodian. So when I saw something that I wanted to invest in, we had to go through a process, and they needed to see the sponsor documents and to validate that I was in a passive role. Because with a self-directed IRA investment, you can't be in the driver's seat necessarily, right? You can be advisory and you can be around the periphery, but you can't have an active day-to-day role in that investment. So fast forward, I'm now using this company in Austin. It's a startup. It's about 3 or 4 years old. You can all go to the website. It's rocketdollar.com. They are a certified registered IRA custodian, and they also have a unique system whereby they set up a checkbook for you and an LLC that's related to the IRA. So the IRA actually owns the LLC that they set up for you, and they make the LLC's operating agreement match and conform to their custodian agreement and regulations to keep you in line with the IRS regulations. So when I first started with them, I didn't just plop a bunch of money over there. I believe it was $1,500 setup fee. I was able to, at that point, that $1,500 got my account set up, got my LLC registered and set up, and my bank account set up, and my EIN and everything. So I was ready to go. And then I think I rolled over at that point $1,000 from my conventional IRA account into that account, and I just had $1,000 sitting in their sweep account invested in mutual funds or other, short-term obligations. Then, when I did find, it was probably about 6 months later, I did find an investment that I wanted to make, and I was going to put $50,000 into an investment that one of my friends was doing. So I called my regular custodian for my IRA, and I said, I want to do a rollover, partial rollover of my funds. And I rolled over $50,000 into the checking account, the LLC, which the IRA owned. And then that LLC, I have the checkbook for. I signed all the documents on behalf of the IRA, and then wrote the check for $50,000, and I was in the investment. All right. The net result of that is, on that first investment, my $50,000 investment over a 3-year period garnered me, I believe it was a little bit over $100,000 was returned to me. So, I doubled my money tax-free, right? So now all of a sudden I had making a deposit back into that LLC for $103,000. I could have no taxes due on that, right? That wasn't even really reported on the tax return. It was reported to the custodian that a transaction had taken place and that we went back to cash. That was the only reporting that was done. I could have at that point rolled the $103,000 back to my conventional plan. But I ended up going to this meeting and finding someplace to put $100,000, right? So again, I went through that process. I've got some friends who also leverage with your IRA. You can make loans, like, say you don't want to invest in the deal, but somebody needs like mezzanine debt, all right, like additional equity to get a deal done. Because they're not getting enough from the bank, you can loan $10,000, $20,000, $50,000 from your IRA. Those shorter term loans, we typically see rates and returns of anywhere between 8 and 12%, depending on the situation. But, there's another opportunity for you to take some idle cash, loan it, and be secured. There's ways you can secure this, like if, Nate or myself was buying a building, and and I've done this before. You go out and you borrow $100,000 at even 12% interest that is going to be short term because you need to finish some renovations and get a tenant in, and then you want to bring the bank through for get an appraisal done after the building's renovated and occupied, right? So there's different uses and different ways to lever that self-directed IRA. Another good example, everybody knows Mitt Romney, right? He was one of the founders of Bain Capital, one of the largest private equity companies in the country. I think they still are one of the largest private equity companies. All right. But when the 6 original Bain partners were approached to make an investment in Staples in, I think it was 86 when Staples was founded. Each one of those partners, Bain Capital didn't make the investment. They each invested that totaling $4.5 million into Staples from their IRAs. Okay. And then they saw a 70x growth on that money in their IRA. So hopefully, you're all seeing that in your IRAs. Right. But, I think, the bottom line is, we as investors see good returns, on real estate. I mean, most are good. There's always those trouble ones, but your typical cap rate that you're seeing, is about an 8% return. So leveraged return, because you don't pay all cash for the property. You probably see, on average, probably a 12 to 14% cash on cash return on your real estate investments. Are you seeing that from your stockbroker or your IRA custodian, right? They don't have that option when you are clicking the boxes on American funds for the different, risk allocations and breaking your money up, right? So, like I said, I'm personally not a stock market guy. My brother and my wife are both stockbrokers, and I don't have any money in the stock market right now. Right. I am fully in real estate, and as much as I can, I do through my IRA and make investments through my IRA, which is easy to do. Right.
So Paul, I have a quick question, on that. So if somebody takes the money, rolls their IRA, acquires a property, they have cash flow from the property. Okay, can they take that cash flow out? If they take it out, that I'm assuming that is taxable income?
Right. So you're right there, you're breaking one of the active rules. It's not arm's length. You can't be actively managing the property, right? So you can't directly go buy that for family. You can go, if Nate, for example, finds a 4-family or a mixed use building that's, $1.5 million that he can, lever at 70%, he's got to raise $350,000 to do that, so that's what we do all the time is, hey, I'm going to be the lead on that deal. I'm going to get a piece of the upside, right? And do a normal syndication. I'm going to pay the investors 8% preferred return, and then split the profits above that with them. And then if a sale was made, the the investors would get paid back first, and any gross upside beyond that would get split, with the GP. So, at that point you'd be a limited, right? And you can still participate, like, you have 2 or 3 partners coming together, but there is an arm's length regulation that you've got to be very careful of.
So the other question then is, we've talked about possibly creating, an LLC for investors in the company, where that LLC, would then be, managed by certain people, within our company and be an investment vehicle. Would something like that qualify for this type of IRA money?
Yes. You can invest in anything that you would as an individual. You can invest in with your self-directed IRA, right? There's just, the sponsor, whoever's putting the deal together, just needs to, have the right attestations that they are complying with and will comply within IRS guidelines. And again, that's mostly around that arm's length kind of thing, right?
So just in summary, this isn't, you can't do a direct purchase, but what you can do is invest in a syndication, give loan money to someone who is doing a deal. You could do those types of things with this.
Yes.
Yeah.
All day long.
Okay. I see Anna has her hand up.
Hi, Paul. So the question I have is about the limit. Is there any limit to how much you can fund your IRA with or contribute to in a year?
No.
Yeah.
So there are limits to what you can contribute into your IRA or Roth. If you're younger, you should be looking at a Roth. All right. So there's different ways to handle that. And yes, there are limits, and it's based on a percentage of your income with a cap, but I'm not gonna, that's a whole nother conversation.
Okay, no, that's
Right.
fine. I was under the understanding there was a set limit. So when you had shared your story about 50,000, that's what got me a little confused. But you're saying it's actually a different formula.
I'm a lot older than you are. All right. So I've got a bunch of funds accumulated and things that I have been nurturing for the last 15 or 18 years and multiplying the value of my IRA like multiple times with the things that we have done. All right. So
No, I understand, but you had
so
talked
I
about,
could, so if you got $500,000 in your plan, you could put the whole $500,000 in. All right.
in
So
a new, that's what in the new, what you had talked about was you created a new self-directed IRA with Rocket Dollar. So because you had existing IRAs, there wasn't a limit
Mhm.
as to what you could fund that with?
correct. I had four,
Okay.
I had four other plans. Okay.
Got it.
That I would do rollovers into the new plan.
Got it.
Right.
Okay, so it was
That's
really a
not a
roll.
taxable event. So if, you've got 200,000 with this administrator and 150,000 with this one, okay, you could direct 50,000 from each one of those into your new Rocket Dollar account.
Got it. So because
again,
it was a
so-
rollover.
right, it's a rollover from one certified custodian to another,
Got it.
right?
Thank
But
you.
and everybody's plans are different, and your tax advisor will help you maximize what you can put into the plans. All right. But that's an individual conversation. I'm talking about how to get the money out and make more than your American funds or, other options. Because even the aggressive options, they're not as aggressive as you can be if you so desire, as we can do with returns on real estate. And, I see so many people doing creative things and making so much money in real estate. You've got to think past being a broker and why are all these people buying these investment properties? Why are they so desirable? Because they're making a boatload of money, right? So, another strategy is if, across the board, whether it's your IRA or not, if there's a ground up opportunity or an opportunity to build something and develop something, get approvals, you can turn a very inexpensive piece of land into something very lucrative quickly. And I've done that a few times in my IRA, right? And made, 10x, right? And most of it was, sweat equity, went into getting the approvals, all that type of stuff, right? But in those situations, right? So I was an investor, I was a limited partner investor with my IRA, but I was also a consultant to the deal, right? So I was consulting, providing services, getting approvals, for the project, right? So I was value add, right? But the key is you can't just go take any money directly. That's the investment is made from your IRA. Any returns go back into the IRA. And I'm sorry, I got to grab my charger. My battery's going to die on my laptop.
So I think you can all tell that Paul is very creative in his deal making. And again, I do just want to caution that you have to remember, right? Every investment that you make, whether it be stocks or real estate, can always have a potential downside. We're fortunate because we are professionals and we know the market. And so we have a little bit better handle, maybe on real estate deals than we would on investing in stocks and things like that. Or I can tell you, I, for one, know very little about, so I'm wholly dependent on, my advisor, to tell me what to do. But in these real estate deals, we have the knowledge to be able to do them and make the type of returns, that Paul is talking about.
I think something to add to that is, challenge you to, become involved and learn, right? Because, even just being the broker, all right, we can show you some strategies and tips on what to pay attention to, because you'll learn, right? As opposed to letting things happen in the background and things that you don't particularly usually pay attention to as a broker, like how the financing is structured, how they structure the underlying LLC, right? So, that's more the art of the deal rather than the science of the deal, right? The normal transaction flow. And, that's the nuts and bolts on how, we make most of the money in the structure, right? So, I'll challenge all of you with, go find a property that you see just listed or about to be listed, whether it's your listing or not, and go, this looks like this would be a great investment. Okay, bring it to us. Okay, we'll go through the process with you of the analysis, show you, a couple quick things that we'll look at very high level on whether or not it's feasible for an investment. All right, but you'll get paid a commission on the acquisition. You'll have an opportunity to participate, in the investment, and also have the potential to earn some equity for bringing the deal to the table. Right? So, there's a lot of different ways to slice and dice and make money, but, with all you guys' different boots on the ground in different places here, there's no reason that collectively we can't find some great investments that we can all go into together, and we can structure those very easily.
So Paul, we have a couple of questions here. So Scott is asking, what custodians allow this and how do you tell the difference?
So there's a bunch of different custodians that do allow it. But what you need to do is look at with their process, right? You direct IRA was cumbersome because, I'd go and look at doing an investment and there's a guy raising $4 million and I'm putting 50 grand into it, right? It's a yes or no. It's not, hey, my custodian, and I ran into this a bunch of times, my custodian wants this language changed in your offering documents, and they're like, yeah, okay, goodbye. Right? So, you've got a little bit more autonomy with the self-directed, and I personally have found Rocket Dollar to be the most flexible, and I know at least a dozen people in our SEC group that have had good luck with them. And then I guess a little further, any of your current custodians, they can't question like, why are you sending this money to Rocket Dollar? It's send me the form and I am rolling over $25,000 to this other plan. End of story, right? It's not because you're moving from one registered custodian to another. I hope I answered part of your question.
I think you did. And then Margaret was asking for your contact info, which Erin has put in the chat for anyone who would like to contact Paul. What other questions do we have about this?
I have one. So for the LLC owned by the IRA, can you invest in multiple syndications or are you focusing one at a time?
So in my Rocket Dollar account right now, I've got 6 different investments and 5 outstanding loans. Okay, right? Because I mean, they were, one of them was 10,000, one of them was 20,000. Somebody needed short-term money. One of them for an air handler. One to just get some more due diligence done before they can finish their raise. Right? But I'll take the 12%. Right? Right? When you do things like just for having to go through the process, I want 12% on my 20 grand with a minimum 6 months interest. Right? So it's going to cost him a little bit more, but that's great income coming into my IRA on $20 or $20,000, isn't it? Right? Of course, you've got the bookkeeping obligations and stuff. We operate in our Society of Exchange Counselors group. It's a very close group. Like each one of those loans is like a handshake kind of thing and a 4-sentence little promissory note. So It's a little easier for us to do that, but as you know, it's easy to secure yourself. If somebody was going and buying a single family, a lot of fix and flippers, the guys that fund these fix and flips, you see these people that want a loan on those all the time, guaranteed they're IRA lenders, right? So, you try to do as much as you can inside of the IRA, because it's all tax deferred.
And that's all within the same LLC that's owned by the IRA?
Yeah, and the LLC is the investor instead of you. It's Scott's IRA, care of this custodian, care of Rocket Dollar. I forget what their underlying custodian entity is, but rocketdollar.com is the website. But it's a pretty cool tool to employ, and just have at your disposal, right? Because the typical custodians, what are they putting you in? They're putting you in, they give you American funds, and then American funds has 8 different choices of, based on how old you are, here's what an allocation you should be, and what have the yields been on those for the last 5 years? 2%, like 12%, or 3%, not much, right? 6, okay. So you younger guys are a little more aggressive in those fun things, right? But again, I live what I preach. You know what I mean? So I'm in the real estate business. I'm in the real estate business. I'm not in the business of owning stocks. My shares. I'm one of the founders of the Hudson Valley Startup Fund. Okay, we are a member managed angel investing fund. We've made 14 investments in startups in the Hudson Valley. I'm one of the founding members of that. My founding $20,000 investment is made from my IRA. Right. So if we found a Facebook in that kind of thing, my investment, goes up 100x. All right. It's in my IRA. Right. So, there's another use besides real estate. You want to go make an investment into some type of company. All different ways you can make money.
And that type of investment, Paul, if you do it through Rocket Dollar, you can do the investment into a business as well through there.
Hey, you know what? You could invest in a title company or an insurance company, right? There's all types of investments you can make with your self-directed IRA. And I understand there's still opportunities to invest in 2 of those types of businesses.
Good one. Okay, the name is it's at the top of the chat, rocketdollar.com. That is the company that Paul has been talking about. And of course, he makes a disclaimer that anything that you hear here, you should check through with your accountant and your attorney. He's sharing with us what he's doing. And it may or may not be right for you. Well, the Hudson Valley Angel Group, Paul, what's the name of that?
The Hudson Valley Startup Fund. So we actually, there were 4 founders, and we brought together 50 investors with our first $1 million fund that we did. And it's member managed, right? So we set up an LLC where there's 50 members that have equal votes, and we are the fee managers. Okay. So the fund can make up to $150,000 investment into the startup, but most startups are looking for $500,000 to $1 million. So what that did was gave those 50 investors what we call a sidecar opportunity, right? So if you see the team and 50 people have vetted and are available to help nurture this investment because the fund is in it. So the fund goes in for 150,000, and you see this group of peers in the room with you that just did a thorough due diligence, okay, and are excited about the investment. Then we find, some of the members have the opportunity to put in 100,000 next to the fund and know that the fund's managing the investment on everybody's behalf. So it's a pretty cool structure. We play Shark Tank
I was just gonna say, you're the Shark Tank of the Hudson Valley.
We play Shark Tank once a month. We have 1 to 2 entrepreneurs coming in, present to the group. We typically get 20 to 30 members at any monthly meeting. And they come in and they get 15 minutes to present, 15-minute Q&A, and then we throw them outside of the room and we talk about them for 15 minutes and decide whether we even want to consider going into due diligence. And if we are going to do due diligence, we let them know we're going to start due diligence. And then they leave, and then we put a due diligence team together. And we've got people ranging from manufacturing to real estate to tech to engineers, architects, to every walk of life you can imagine in the Hudson Valley. All right. So we've got tentacles to all these different specialties, because for a startup, it's not just about the couple $100,000. It's about the relationships and people they can lean on to really grow the companies. So that's been a lot of fun over the last 6 years, trying to spur entrepreneurship in the Hudson Valley and, really stop the brain drain from the Hudson Valley, right? Because we were seeing that people who were smart and had these startups were getting sucked into New York City because that's where the money is, right? And eventually, and they'd have a support group and a support network around them in addition to the capital. We created that support network in the Hudson Valley.
I think this is really cool. And it's funny, as much as you and I have conversed over the time we've known each other about many, many different things, I never knew that you were doing this. I have no idea how you have enough hours in the day to be involved in all of the things that you are doing.
Yeah, well, that coupled with 172 days on the road last year. I was out of Kingston 172 days. Was pretty interesting.
Mm-hmm. So Scott has a question. Scott, do you want to come on and ask this question? Because I'm not sure if I understand it.
Yeah, so outside of like the tax implications, like at the end when you're withdrawing, in terms of the difference, is there any difference in the process between a regular IRA and a Roth IRA? Or
Putting the money in or taking the money out?
Putting the money in.
So putting the money in, yes, you're young enough. You should probably, again, who's your financial advisor? No, I'm serious. Once you start having a liquidity, you need a relationship, right? So, and you want to maximize as much as you can. I know my son is getting creative and aggressive with his Roth, and the limits are different. You can put more in when you're younger, right? But, again, that's get to the right professional on that. But no matter which one you can, I know at your age, you can contribute more into the Roth, okay, and grow that number quicker, right? But they both would function the same way when you roll over to Rocket Dollar, right? So I'd rather not spend the time on that because I'm not that guy. My wife's a stockbroker. And unfortunately, she's here right now. Otherwise, I'd go for a lifeline.
No, it's very helpful. Thank you.
Okay, who else has questions for Paul?
And from a deal perspective, if you come up with deals and, need anything vetted, Nate or I, have the ability to, give you a quick yes, no, maybe, right, kind of thing. But, definitely keep your eyes open, for a deal. How would you like to identify a $2 million investment, get paid, half of the brokerage fee, and then, additionally get, a few percentage points of the ownership of the entity as an additional referral fee, right, for participating in the deal.
I'm in.
Right.
Go out and find it, Scott.
So we do that every day. Okay. Rosemarie's been coming to our national SEC meetings, and you see it happen real time in the room. Somebody will go up and, you'll see a deal presented and somebody will go, hey, I'm interested. I'll do that deal. And then all of a sudden 4 people are raising their hand going, hey, okay, you're going to lead. I'm in. Right. So, again, raise your hand, put the deal on the table. Don't think about equity. Where am I going to get the money? Money follows deals. You identify, and we can put a package together for a good deal. I don't care whether it's $20 million of capital needed on a $70 million acquisition. We can do that. You know, we're doing raises for apartment complexes for a large national, very well established developer. And you know, we're literally sending emails out and, you know, raising $15 million in a week, right, with via email, without even, just to our normal investor base, right? So it's not hard when you've got a good deal to put a lot of capital behind it.
Okay, anybody else have any questions? All right, well, Paul, I want to thank you for coming on with us today. One of the things I am going to ask anybody who's on here is if you are interested in participating in an LLC, in an investment LLC, where we will probably have a minimum investment of $25,000. And again, this would be the LLC going together, pooling together this money to buy a bigger investment. I would like for you to shoot me an email and let me know that. Also, I will need to know if you are an accredited investor. Okay, so we can have non-accredited and accredited, but we need to know who is and who isn't. Basically, if you did participate in any of our investment opportunities to date, or title or insurance, you do know that accredited means you have a net worth of at least $1 million, not including your principal residence. Okay, so whatever you have equity in, if you have $1 million or more, you are accredited. So I just need to know that, because depending on the type of investment vehicles we do, there are certain limits to the non-accredited investors you can have. So we would need to know that we would be able to meet the thresholds of the SEC qualifications.
Right, and the, yeah, and a 506B, which would probably be, because it's not a mass solicitation, you also all benefit from the fact that you are in the real estate business. So it is assumed that you are sophisticated. You're all sophisticated, right? Raise your hands. All right, so that you know, goes parallel with and kind of trumps the accreditation also, right? So that gives you additional merit. So, you know, there's a way we can dance around that and get everybody in if need be. It's also, everybody is connected to Keller Williams. So there is you are all entities and not broadly solicited by IRS definitions, but that's another Zoom.
All right, well, thank you so much, Paul. And I appreciate all you guys being on here with us, and we will be back. Look at the training calendar next month. Not sure what the topic's going to be, but I have a lot of education and learning and connecting that I'm going to be doing between now and then. So I'm hoping to bring you something good and of value. Thanks a lot, Paul, for being on, and we'll see you guys next month.
Okay, have a great day, everybody. Bye.